Music, the soundtrack to our lives. Everyone has a favorite style or genre and will defend that taste in music against any challenger. But whether you like the smooth jazz stylings of Kenny G or the epic historically based rock of Sabaton, there's one constant underpinning the world of music, the new foundation of how the next generation will listen to this medium. Today, we're looking at the colossal music streaming titan, Spotify. Having only started in 2006, Spotify is a relatively recent phenomenon. Founders Daniel Ek and Martin Lorentzen wanted to build a platform for listening to music that was both easier to use than any pirating site and cheaper than iTunes. Originally, the platform was only available throughout Europe, and it was only after a series of changes and the introduction of a premium tier that Spotify was finally able to sign a contract with US record labels to get the platform into the country. With that agreement, Spotify launched in the US around late 2011, but quickly doubled its paying subscribers to 2 million by the end of that same year. After proving its business model, it was time to build out the platform even further. And it was in 2013 that Spotify started to do exactly that. It acquired Tunago. This addition could and would build out Spotify's discovery algorithm, both through Spotify Radio and curated playlists, further improving the platform. Yet Tunago was only the first of many acquisitions of smaller companies used to build out the Spotify platform. In the beginning, these acquisitions were mainly focused on improving search and analytics for artists. There were also some other odd acquisitions along the way though, like MediaChain and Soundtrap, the former of which focuses on blockchain tech and the other on actually making music. Today, Spotify boasts over 400 million users and almost 200 million paying subscribers. But this empire wouldn't be possible without the special quality the founders had in the beginning and still carry to this day, a long-term mindset. You can hear it everywhere on the company's most recent investor day. Spotify's management team isn't interested in the next quarter or even the next year. Ek talks about entering 3 new verticals over the next 10 years. Plus, you can see this forward thinking in the company's earnings reports, where it outlines revenue growth over the last 5 years, unlike most others' year-over-year comparisons. On top of that, the company also plans to 10x its revenue over the next decade. While this plan is certainly ambitious, I think it just goes back to that forward-looking nature of the company. I think this long-term vision is what has allowed Spotify to become such a massive platform. Each vertical it enters, from podcasting to audiobooks, is both well-planned and grows quickly. When Spotify entered podcasting in 2018, I didn't think it'd go very well, especially when it announced a deal with Joe Rogan reportedly worth $200 million. I firmly believe the company was wasting its money. But now, podcasting is one of the backbones of the platform, drawing in millions of listeners who otherwise wouldn't be on it. That same long-term thinking powering Spotify's success can also help us as investors. So I think it's time for us to change our thinking. If we expand our time horizons as Spotify has with its long-term plans, our returns are likely to improve. To quote the famous investor Seth Klarman, "We enter every trade expecting to hold to maturity in the case of bonds, and a really long time, sometimes forever, in the case of stocks." If you haven't heard of him, Klarman is the founder of the Baupost Group, an investment fund that has compounded growth at 20% per year since its inception. So if there's anyone outside of Warren Buffett to be giving advice, it's definitely this guy. Now, while I don't expect anyone to hold a stock forever, I think lengthening our holding period for stocks is a must in order to beat the market over long periods of time. Speaking of beating the market, let's see if Spotify has the ability to do so. And in order to figure this out, we need to do a deep dive into their financials. First up, we have revenue growth, which has been explosive, doubling over the last 5 years. On the flip side, free cash flow has been far less explosive and even inconsistent, but this is somewhat expected given the large investments made in the last few years. I think a big plus is that Spotify actually has free cash flow. Many high-growth tech companies don't, so I think this gives Spotify a great foundation. Next is shares outstanding, and big surprise here, it's increasing. Yet despite this, it's only been about a 10% increase over the last 5 years, so not really bad at all. In terms of return on invested capital, Spotify hasn't been great with 6.6% in the last year and a 5-year average of 5.5% ROIC. The returns on capital have been quite low. low, but that seems to be in a better position with total assets of $4.4 billion, $3.6 billion of which is cash. Thus, it compares very favorably to the company's $4.9 billion in total debt. But as for dividends, despite being profitable these last few years, Spotify has opted out of paying any. Overall, a fairly strong balance sheet with some concerns with the returns on capital, but again, no big financial issues. Solid financials alone do not make a market-beating compounder, however, so let's examine how Spotify plans to grow its business and become an all-in-one creator platform. It's only until very recently that Spotify started to make this transition to an all-in-one creator platform. Podcasting would be the second space Spotify would attempt to compete in, and this cash-incinerating venture has proven a step in the right direction, as almost 30% of users now listen to podcasts. More importantly, Spotify is demonstrating its capability at competing in new areas. With these new products comes higher revenue per user and more users joining the platform. In order to continue to drive user growth, Spotify announced its newest venture, audiobooks. The billion-dollar space has long been dominated by Amazon's Audible, controlling nearly 50% of the audiobook market. While this feature is still fairly new, I imagine Spotify will quickly claim a large part of the market. The reason for my confidence is in Spotify's ability to make great acquisitions. Very reminiscent of the early eBay days, Spotify is quickly able to compete in new areas by just buying the companies already operating in the space. Findaway is the most recent acquisition for the company, and all of a sudden, Spotify now has access to Audio Engine, a library of over 300,000 audiobooks. On top of this, they now own the supplier of audiobooks to dozens of other companies like Audible and Apple. This new vertical is enhanced by Spotify's significant investments in its AI-powered recommendation algorithm. By now, I imagine you're beginning to see the complex web Spotify is weaving. And while their goal of reaching $100 billion in revenue by the end of the decade may seem ambitious, it seems the company is well equipped to reach those goals. And if you want to help this channel reach its goal of 2,000 subscribers by the end of the year, consider dropping a like and subscribing. While you may think these new product offerings are where most of the revenue growth is coming from, it's actually not. The fastest growing segment of Spotify's business is ads. Having grown 31% year over year, ad growth means new subscribers are joining the platform. And while they aren't premium subscribers, they're still an important part of the platform as potential subscribers in the future. Much of this user growth is from emerging markets like Latin America and Africa, places where there's virtually no competition. One of the ways we can see if competition is increasing is through a metric called churn. This is the rate at which premium users are leaving the platform. In these emerging markets, Spotify has a churn rate of just 2.4%. Conversely, Spotify's churn in its largest markets is a bit over 6%, leaving the company with a total churn of almost 4%, which is still very low compared to the rate at which Spotify adds paying subscribers. Also worth noting is that the churn rate is falling virtually across the board. But there is a chance that this trend does not continue. Instead, Spotify's future could look very different, a future where product launches flop and they're unable to keep up with competition. The worst part is this future may be entirely out of the platform's control. See, Spotify has a very heavy reliance on music labels. These labels supply 70% of the music on the platform. That means Spotify has to continually maintain and renew these contracts. The big risk, of course, is the record labels being incentivized to no longer support Spotify. This could be either controversy surrounding the platform or just not getting along with management. But a far scarier risk is that of competition. Big tech companies like Apple and Google have built vast ecosystems that, once a customer is inside, are very hard to escape from. If you're already using Apple products, consumers are incentivized to stick within the ecosystem and get Apple Music. The same thing with YouTube Premium. This service comes with YouTube Music for free, and since these music services are such a small part of the overall company, they can afford to be run at a loss. Spotify, on the other hand, would be unable to run at such a significant loss without additional capital over time. The way Spotify has responded to this risk is by trying to build out its own ecosystem, by including podcasting and audiobooks in hopes that the platform is a better value add than any of their competitors' offerings. This puts additional pressure on the management team not only to expand into more verticals, but make their existing product as profitable as quickly as possible to be able to reinvest that money back back into the business. As I said earlier, about 70% of the music on Spotify is provided by record labels. The other 30% is from independent music artists, and there's another big risk associated with this. This is the complaint from these artists of not being paid enough by Spotify. While this trend reached a boiling over point in 2021, Spotify managed to navigate this controversy and still managed to pay artists very little. But these concerns have manifested into real action, with fairly large artists having pulled their music from the platform over the years, and will likely remain a hot button issue over the next few years. But overall, Spotify has managed to remain resilient in the face of these and many other controversies, and continues to expand its platform. So that leaves us with the question, am I investing in Spotify? The answer is yes, but not right now. While Spotify does seem well on its way to becoming the total creator platform, I think valuation has some more coming down to do. Spotify continues to trade at over 60 times free cash flow and a continually negative PE. Despite this, I would like to start picking up shares in the $55 to $60 range. This represents a 20% discount on the current price, and I believe would be a pretty good entry point. But that's all I have for you today. If you enjoyed, I'll bet you enjoyed the video popping up on screen now, and I would love to hear your thoughts on Spotify and if you own the stock in the comments below. As always, this is Dollars and Cents.